welcome to our live stream. My name is Tiffany Pledger, trainer here at the Knowledge Coop. Just for today, any comments we'll be holding till the end, or if there's no time, we'll catch them next time. Today, I have here with me Matt Graham from MBS Live. Recently, Matt did an academy course with us on understanding the market, which is a fascinating concept. He's going to go through that a bit more. Matt, do you want to start off by sharing some of your background? What got you into this?
Sure. Yeah, I started out as an originator, like many people that move on to other things in the mortgage industry. And when I was doing that, I was really curious about what the nuts and bolts were that underlied market movement and mortgage rate movement. And I realized there was a pretty big rabbit hole there to explore and have been exploring it ever since and have built MBS Live to be the product that I wished I had had back in the day when I was originator. So, yeah. That's about
Yeah,
it on MBS Live.
yeah. I was originator for a long time as well, trying to watch the market. You get used to seeing those little fluctuations in rates. You know, every single day, rates are just
Right.
tiny bit, back and forth, even several times throughout a day. But sometimes, every once in a while, you see those bigger changes. Like, what can cause that?
Well, that's a great question and a very broad question because the financial market, of course, is big and complex. Hundreds of billions of dollars changing hands every day, and rates have a lot on their mind. Traditionally, we think about rates responding first and foremost to the economy. That's one of the two big inputs for rate movement, and then there's inflation, which directly impacts what the value of an interest rate is going to be over time. And both of those things are considerations for the Federal Reserve, which sets
Mhm.
monetary policy that dictates short-term rates, which are a little bit different than longer-term rates like mortgages, but can have a big impact over time.
Term rates meaning
And
like, right?
go say again.
Said short-term rates meaning like car loans,
No,
or am I?
short-term rates. I'm sorry, being like things like a 2-year Treasury yield as opposed to a 10-year,
Oh, for
and
investment.
also like the Fed funds rate is an overnight rate.
Right.
So an auto loan, it's a little bit of a different sector because it doesn't trade among the same investors as those who buy mortgage debt and treasuries. But yeah, it would be a short to medium term in that sense. And
Oh,
I think the point is duration, how long a loan lasts, is really important to how investors treat it because they're going to have to account for what they think might happen in the future with rates.
mhm.
So, I mean, to answer your question, economic data is huge. Fed announcements are huge. And monetary policy shifts, whether they're from the Fed or even from foreign central banks like the European Central Bank or quote unquote ECB, also can be a pretty big deal.
Okay, great. And I think you had some charts you were going to share to show us all of this.
I totally have some charts I'm going to share. Let me find them. Oh, yes. All right. I'm getting there. And I think this is the right window. Okay, so let's scroll to the chart we want to start with. First off, we will be talking quite a bit about the 10-year yield when we talk about mortgage rates. And the reason we do that is seen pretty plainly in this chart. So 10-year yield is in blue and mortgage rates are in orange. They're not on the same axis because mortgage rates are always trading a bit higher than the 10-year yield. But this chart shows that there's just so much correlation there. A lot of
Mhm.
people actually have said, somewhat mistakenly, but with a lot of truth to back it up, that mortgage rates are based on the 10-year yield. That's not exactly true, but as you can see, there's a ton of correlation.
Right.
Um, so in 2022, especially, we've seen a lot of big drama surrounding the Fed, and they have been responding primarily to inflation. And there's been a little bit of a difference between short-term rates and long-term rates when it comes to that inflation component. And now, more recently, economic data is becoming interesting. So here's a chart that shows shorter-term debt versus longer-term debt with a 2-year Treasury yield in orange and the 10-year in blue.
Okay.
CPI, do you have a question?
No, no, I was saying, yeah,
Oh,
the consumer price
gotcha.
index.
So yeah, CPI is the consumer price index. That's the biggest inflation report around.
Mhm.
And it's not necessarily the one that the Fed says they're most concerned with, but it does come out earlier than the one the Fed likes, which is PCE. Incidentally, it'll be out tomorrow, but I digress. CPI, this shows an example of how shorter term debt can react more readily than longer term debt because it has a bigger impact on the Fed rate hike or rate cut outlook. And Fed rate hike expectations are basically focused on that overnight rate. And an
Mhm.
overnight rate is closer in time frame to a 2-year yield than it is to a 10-year yield. And so the shorter term debt is going to react more. And I apologize, I have a few charts to scroll through to get here with the screen sharing system. But here's
Mhm.
another example of how the CPI reports have come into play with the very shortest term rate, the Fed funds rate. And in fact, here we have Fed rate hike expectations. The reason we would view rate hike expectations is that the Fed only meets 8 times a year to potentially change rates. So that line isn't very interesting. But this line can move every minute, every second, so it can react more readily to the economic data. This
Wow.
shows just how massive the reaction was to the inflation report that came out in June. And
Mhm.
again, a very noticeable reaction to inflation data in July. At the same time, I think we have a chart in here somewhere that shows here we go. So this shows how the 10-year yield was moving at the same time.
Wow.
At first, in June, it did go up, just like short-term rates or rate hike expectations in this case. And that was because the market really was forced to quickly reevaluate what it thought it knew about how inflation might be leveling off and what the implications were for Fed policy. It affected rates across the board because the Fed was only going to get more aggressive with the parts of its policy that were going to impact longer term rates. But then in July, we see that the impact was almost exclusively on the shorter term rates, the teal line.
Wow.
And longer term rates, like the 10-year yield, really didn't react much at all because at that point, keep in mind, if you're a 10-year treasury yield, you have to consider what's going to happen over 10 whole years. And if inflation is high enough to make the Fed really aggressive with hiking rates and trying to slow down economic activity and inflation, then slower economic activity actually puts downward pressure on 10-year treasury yields. So
Mhm.
a recession or lower prices for any reason are generally good things for 10-year yields and mortgage rates. And so I just thought this was an interesting chart to show the dichotomy between short and
Yeah.
long-term rates. And that's something to consider going forward. In fact, a lot of analysts are saying that that 10-year treasury yields, mortgage rates are definitely thinking harder about topping out for 2022 than short-term rates may be.
Really?
So beyond Fed announcements and inflation, we have economic data. This
Mhm.
chart shows two things. Oh yeah, economic data and foreign bond market movement. So in late July, for instance, when the European Central Bank or the ECB came out with its announcement, there was a big move in the European bond market and a sympathetic move in the US bond market. That's
Mhm.
not something that's uncommon to see, especially in the overnight hours, because treasuries are moving overnight. And so foreign market movement can have a bigger impact then. Weak economic data, that's a good thing for rates. That happened the next day. It happened in both Europe and the US, and it pushed rates down immediately, as you can see in the chart.
Yeah.
It's important to emphasize this stuff happens instantaneously when the data comes out. So if we're watching, say, the jobs report next Friday,
Uh-huh.
and or any given Friday, the first Friday of any month, right at 8:30 is when that data comes out, and as soon as it comes out, the market is moving instantly.
Wow.
And yeah, so I'll pause there and see if you had any questions
Yeah.
or if there are any other charts we needed to get to.
I mean,
Oh, I did
again, I'll
have
go
one last one.
go
This
ahead.
just
Yeah.
shows the strong economic data from early in August. We had ISM manufacturing and non-manufacturing reports come out at the beginning of the month, and then a really strong jobs report that pushed treasury yields higher. So that was a good example of that econ data came out. As soon as those reports hit, yields were on the move higher,
Yeah.
definitively so.
I mean,
So
you keep kind of hinting again and again at the role that inflation plays on this. And I wasn't sure if we are going to have time to talk about inflation, but it looks like we do have a couple minutes. So inflation is the hot topic right now. Everybody's hearing about it.
it absolutely is.
What's really happening there?
I think everybody would like to know what's really happening because it's an unprecedented inflation environment where we can't really be sure exactly what the balance is between supply side considerations and demand side considerations. We know that some parts of the demand equation are doing really well based on economic data, but we also know that the supply issues are huge. We know that fuel price issues are huge, and
So
there's a lot of uncertainty.
real quick about
Yeah.
inflation, the main cause is issues with supply and demand, correct?
Yeah, always. I mean, there's that's the only way that you can approach inflation. There's, the supply, or they call it cost push inflation, meaning the cost of goods is pushing inflation onto consumers, and then demand pull inflation, meaning the more consumers are demanding those goods, the more they're pulling inflation higher with them.
Right.
And so, you know, it's a complicated topic if we were going to give it its full treatment, but the Fed can only affect the demand side of the equation. They can't change anything with supply, and they've admitted that. And so that's one thing that makes it tricky going forward. The Fed has to be really aggressive if they want to fight this unprecedented surge in inflation. They really have to tamp down demand, and in order to do that, they have to get really unfriendly when it comes to the bond market, and that's one of the reasons that rates have risen as rapidly as they have in 2022.
You were saying that they're meeting again soon in September, right? What are kind of the
September
forecasts?
21st.
Yeah.
Well, they're generally considered to be down between hiking 50 basis points to 75, kind of in the middle, and they have been for quite some time. And just today, several Fed speakers have said that they will decide which of those two numbers they're going to pick based on the economic data that comes out between now and then. We have
But
another CPI report to get through. Sorry, go ahead.
it's definitely going to be a hike, though, unfortunately.
Oh, absolutely. Yeah. But the good thing is this is that the markets already know that. And so if the market already knows the Fed's going to hike, it can price it in instantly. Traders aren't going to sit around and wait to lose money. They'll adjust right away. And then it's really how reality comes in versus their expectations that moves the market. It's not whether or not the Fed hikes. That's already baked in.
So, is there any reason why the Fed wouldn't hike? I mean, I know it's already kind of set in place right now. They're going to keep hiking and keep hiking, but there's a point where they stop hiking it, right? There's a point where it's been enough. There's a line.
Absolutely. There is a point. And in fact, even at the last Fed meeting on July 27th, Fed Chair Powell alluded to the fact that policy tightening is going to be starting to level off now. We're getting into those Fed funds rates that have historically been considered to be neutral. And they've said we're going to take it above neutral and be restrictive, which is what we need to do. But so they know that that leveling off is coming. And what we're most interested in at the September meeting is hearing what they have to say about what they're looking for to determine when they're going to level off. How many months of stable to falling inflation do they need to see? What sort of deterioration do they want to see in economic data? Because, unfortunately for the economy, they do want to see deterioration in economic data. They want to see people lose jobs. It sounds bleak, it sounds grim, but that's what they want. They want to slow down the economy to bring inflation down. And so they'll have certain benchmarks in their mind that when those benchmarks start getting hit, you'll see the Fed increasingly talk about, hey, maybe we're not going to hike rates at this next meeting. But they have all said that they would like to keep rates level at new high levels or keep rates flat at higher levels for as long as they can, not to be mean, but just because they feel like that's going to be the best way to accomplish their goals, as opposed to hike, 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 and then cut really rapidly in a sort of an emergency sort of way. But
Right.
you asked what might lead them to cut rates or to stop hiking if the economy tanked in some crazy way. Say something unexpected happened, and unemployment shot up rapidly. There was negative job growth, and things just looked really bleak, and inflation was dropping precipitously. None of that's going to happen by September 21st. But if it were able to happen, then you might see the Fed say, we're going to hold off on hiking rates this time.
Oh, goodness. All righty. Well, all of that information was fantastic. Thank you so much for the charts, for the explanations of everything. I feel like I understand it a bit better now. Hopefully our audience does too. We're going to go ahead and wrap up this live stream. Thank you everyone for joining us. And remember, all of our live streams are available on our member platform, the Coop. Find past live streams and check spot for future ones all in one space. That's all for us. Thanks again, Matt.
Thanks for having me.
See ya.